Hi, I'm Joseph Falbo, Certified Financial Planner. Today we're going to talk about is change on the horizon. So in January, the market, despite years of high interest rates, despite all the talk of recessions every year or every so often, all the recession concerns, the market has hit an all-time new high. Now this is largely driven by corporate earnings, strong corporate earnings, the job market, and consumer sentiment has been improving. Now, whenever we're on a long winning streak or whenever the markets hit a new high, it's tempting. Human nature starts bubbling up in us, and we may hear it on the news that you should lock in your gains, right? There's some sort of correction coming. And after all, no one wants to see their gains evaporate, right? But before making any investment decisions like that, it's important to consider all the perspectives out there. Let's talk about the what-if perspective. Now, first I want to say, if you were with us, you were in a diversified portfolio, right, suited to your long-term goals in your plan. You'll hear me say that over and over because I want to make sure that's the basic and most important piece. But let's go back to the what-if perspective. For example, if you were to lock in your gains, what would you do with the money? Where would you put it? Where would you do with it? How long would it do? How would you know when the market was going to correct? How would you know when it would be the right time to get back in? While we might be thinking we're looking to lock in gains, a lot of times it's just another form of market timing. And market timing, if you're doing this for a long time, you realize and have experienced market timing can be very costly. Not only is it costly, it's very stressful to do. So let's talk about something I think is important to know as well, and that's the historical perspective. So according to Truist, the market has historically performed very well after making new record highs. Since 1954, get this, they found that the market was higher 1 year after making a new record high. After one year, 93% of the time. Interesting. JP Morgan found that investing on days when the market hits all-time highs has historically yielded better returns than investing on any other day of the year. Interesting. So in other words, history does not offer any evidence that a market hitting all-time highs means it's going to go down, or the market is due to go down, or there's a correction coming. If anything, the evidence demonstrates the opposite, that new market highs often result in higher highs. This does not mean it's going to happen. And this is my final thought of this. This does not mean that's going to happen. I'm just giving you a historical perspective. That doesn't mean it happens every time, right? Final thoughts. My final thoughts is it's important to know that the feeling to protect your money is completely natural. You're human. It's completely human nature. But after you can start considering and thinking this through and consider other perspectives, you start to realize, or you may start to realize, that may not be the best or wisest decision. Now, as I always say, and I said it before, have a plan. Have a diversified portfolio suited to the long-term goal in that plan, and then practice discipline to your plan. That is often the best course of action. I hope this message helps you.